Well, coming off the jobs report, the market's seeing a lot of volatility, and we've got the perfect guest for you today. We have Mr. Jim Welsh from Macro Tides. He's going to be here to discuss not only what happened with the jobs report, what's happening in the markets, but why is the stock market sliding the way it is? Jim, welcome to, Friday. Welcome to Friday.
Yeah. Freaky Friday, or I don't know, I suppose to get some kind of alliteration in there. Well, it's always great to join you, Blake.
Well, Jim, you've been with us like literally every Friday for like the last few years, and you're always here to break down the markets. And right now, we've seen a lot of volatility. We just came off some comments from Fed Chair Fed Governor Waller, who was just speaking. There's been a lot of comments. Tell us why the market is convulsing right now.
Yeah. Well, initially the jobs report came out, and you and I talked about it last week. And my take was, I think we're going to see job growth improve from the 114,000 in July. It did to 142,000. And I thought that we'd see the unemployment rate tick down from 4.3 to 4.2. It did. But I think what got the market's attention, Blake, is, okay, job growth improved by 28,000, from 114 to 142. But they revised July and June down by 86,000. So when you start taking into account the revisions, very significant revisions, the report is a lot less strong than just the headline, oh, gee, job growth improved and the unemployment rate ticked down. So I think initially, Blake, equities started to soften, and then as the selling picked up, especially in technology stocks, it really, gathered some steam.
So you don't think we're trading?
Market reacted.
Jim, you don't think we're just trading the number? You think it's everybody's like, oh, that's the number plus a revision? I mean,
I think so, because again, the ISM numbers came out this week, and they were not strong. The manufacturing was actually fairly weak. The services number ticked up from like 51.5 to 51.7. That's not gangbusters. So I think the weakness we saw coming into today was, again, we saw it in cyclical stocks. Technology got hit yesterday and the day before. Technology has been getting beat up because, again, we talked about this at least a month or so ago, that institutions were overweighted technology. And for good reason. They had been outperforming for a long time. But once you make the decision that it's time to, scale back an overweight position, you have to do selling over a period of time. They're not going to dump, the positions willy-nilly. They're going to try to be smart about it. So they try to sell into rallies and so forth. So to me, what we've seen is exactly that, Blake. As people started to call into question, and again, you and I talked about this at least probably 6-8 weeks ago, because I wrote about it in Macro Tides, that all this money's being spent on chips, $50 billion of sales for NVIDIA. But so far, companies only received $3 billion of actual revenue. And so to me, it was raising the question of, okay, we're going headlong into this, but we're not really seeing the returns and results that we expected. And that means you get a pullback in spending. And I think that just that conversation is why sentiment is shifted toward AI and technology in general. It's like, okay, we need a reset here because things aren't going, from goal to goal if you're playing Monopoly. And that's, I think, what's been hitting the technology stocks. Now, you mentioned Waller's comments. Williams from New York talked this morning as well. And to me, it's not like they said anything new, Blake. It's like, okay, rate cuts are coming. And if warranted, we'll do more than 25 basis points.
Yeah. Well,
that should not be news, but for the market, it was, oh God, okay. If the economy slows a little bit more than expected, they're going to be riding to the rescue. And we saw a very sharp reversal in the S&P. I think it was down 78, and it only was down 45. I don't know exactly where it is right now, but that's Waller's comments that, oh, they might, do 50 is what I think caused that very sharp rebound. But those comments, to me, break no new ground.
Yeah. Okay. Well, it doesn't break new ground, but the markets are trading off these headlines, these algorithms, and it is obviously creating a little bit of volatility, which as traders, volatility is great, right? Jim, so you brought a bunch of charts, and I want to go through them with you as we normally do. And remember, if you guys are normal listeners here, on Trader Summit, and you're listening to Jim each and every week, he's been guiding us through this for literally the last couple of years. And Jim, if they need to show your appreciation, they should with a big thumbs up, and comment down below if there's anything that you agree or disagree with Jim as we go along.
Yeah.
So Jim, the first chart you brought was this low savings rate. What does this tell us other than we are screwed?
I wouldn't go quite that far.
Okay.
But
Okay.
what it shows is obviously when the government distributed a lot of money in 2020 and 2021, and the economy was effectively shut down, people saved a ton of money. And then obviously as things opened up, they started to spend and spend. And my point is, if we look off to the left, you see from 2015 and 16 and 17, the savings rate was always above 5%, 5 to 6%, was down to 2.9. So what does that tell us about what's happening? Well, consumers are continuing to spend. We know that on balance, more on the upper end of income than lower end. But the fact that they're sustaining their spending by saving a lot less money, Blake, again, just shows us that there's a stretch going on progressively from the bottom income folks up towards the middle class. And this is a progressive weakening that I think, again, underscores the idea the economy's slowing, it's gradual slowing, but I think it's going to continue.
What happens if the savings rate goes to zero?
Well, that would be unprecedented.
And I got to ask this question just because this chart's like kind of a newer chart to me and probably a lot of our other viewers. Does it go negative if you have people indebted?
It's never gone negative.
Okay.
I mean, we're talking where it's getting down to is some of the lowest readings going back to the last 40, 50 years.
Okay. All right.
So that's
just trying to put it in context for us.
Yes.
Right. Okay.
So that's why I brought this chart is like, okay, folks, GDP was revised up from 2.8 to 3. Consumer spending was upticked, I think, 35 basis points. All right. That all looks great on the surface, but what is powering it? And we talked about it last week. Upper income people have asset values have increased significantly. And they're able to spend, and they are. I mean, look at what happened travel-wise, the 4th of July, Labor Day. But underneath the surface, this is where a lot of people are at. They're spending, but they're not saving, or they're saving much less than they were before the pandemic.
Makes sense. Okay. Well, the next chart you brought is continuing claims. So explain to us what we're looking at here with these two different images.
Yeah, about 5 or 6 weeks ago, you can see the uptick. This is the bottom line is the weeks of the year. So during May and June, the claims were rising. It's on the one on the left.
Oh, okay.
Yeah. So see the weeks there? Yeah. Okay. So at that point, I said, what's going to be interesting and very instructive is we see a definitive seasonality to these numbers. And as you get into mid-July in the 2018, 19, and last year, claims trend down. So if they don't trend down, whoa, that is going to give us a very, I think, powerful signal that the labor market's weakening more rapidly.
Now, do you think that's going to happen?
Ultimately, yes. But we can see they're trending down, but they're still higher than they were in all the other years.
Yeah.
So my expectation is that this is one of the reasons why I said last week, I think we're going to see job growth improve. So this is just something that to me is worth monitoring, understanding the seasonality. Because when it was going up, oh my God. And I'm like, wait a second, we have to take into account the seasonality during May and June into early July. And now it's like, oh, we don't have to worry about the economy because it's well, wait, look at the seasonality. It's important. All right, the one on the right shows quits. Well, when employers were struggling to find workers were leaving their jobs. They were quitting because they could go across the street and get a raise. was the labor market started to become less tight. Fewer people are doing that because if they go across the street, they're not going to get a raise. And so this is a sign that labor market is loosening, no question about it. However, the bottom line shows layoffs. And this is a point we've talked about the last few weeks, is the unemployment rate went up, but it didn't go up entirely because of a bunch of layoffs. It went up in part because people came into the labor market, and the way they calculate the unemployment rate and increase the supply of workers, oh, okay, that's going to make the unemployment rate go up. So my point is, these are all tells that we want to pay attention to. When we start to see layoffs begin to trend up, that's the signal that, okay, we're really on the cusp of a more marked slowdown in the economy. The next chart kind of, I think, will make this point pretty clear, which is, I think it's monthly jobs.
Yep, here we go.
Yeah. Now, if this was a stock, we would say this stock is in a downtrend,
Yep.
So this is monthly job growth. And so what we can see over the last 2.5 years is, from that real peak, but just look from last year, just gradually weakening and weakening. This is progressively, less and less job growth. So again, what we're seeing is employers are hiring less people, but we haven't gotten to the break point where it's not only are they hiring less, but they're starting to lay off people. And that's the crossroads that I think we're going to reach sometime in the next 3 to 6 months, where not only is job growth continuing to slow, where all of a sudden the 3-month and the 6-month average starts to get closer to 100,000 and then under 100,000, but then we see layoffs. So to me, again, this is a very gradual process. The government is spending an enormous amount of money. The deficit is like 7% of GDP. In the last year, GDP has grown about 2.5%. Wrap your mind about that, around that. The government, 7% of GDP in spending as a deficit. So this is why this cycle is getting elongated. For a while, it was a huge amount of consumer savings, but now we're getting down to less and less savings, but yet the government continues to spend a lot of money. And that is what's, I think, holding the economy up, one of the factors holding the economy up. But the trends, I think, are unmistakable.
Okay, well, the next chart you brought, Jim, is you brought the unemployment rate, and
right.
That was one of the numbers that everybody was looking at today. So
yeah, and again, my expectation was that move from 4.1 to 4.3 in July was a little bit of an exaggeration. The main thing, if this was a stock, would you say it's in an uptrend or downtrend or sideways even? No, you'd say it's in an uptrend. The zigzag is working its way higher. Another sign that the labor market is gradually but progressively weakening. And so to me, this is the trend, folks. It's evolving slowly, but I don't see anything that's going to reverse this trend, where all of a sudden we're going to see real growth accelerate, and all of a sudden the unemployment rate's going back down below 4. I think it's going to be the other way around, very gradually working its way higher.
Well, Jim, you're scaring me. So tell us what it means for the dollar right now. So the dollar, it looks like it's trying to resume its downtrend this week. Today's been a little messy. How should I guess it's the best way for me to explain it. But what are you making with the dollar here?
I think there's a reasonable chance. We talked last week. The expectation was, okay, I think we're going to rally to 102 to 102.50, got up to 101.92. Then broke down. It was weak overnight, and then the job number came out, and we saw a snapback. To me, what that kind of looks like is A up to 101.92, B down to this overnight low, and then I think we're likely to see the dollar move above that 101.92 to complete wave 4, and then we're going down and making a lower low. So the trend is down in the dollar. It just got very oversold. As you can see, the RSI was comfortably below 30. And I think this rally is nothing more than relieving that oversold condition. But I think, once the dollar took out the 100.62, that negated the idea of a triangle. So as you know, we talked, it was like, okay, we're going to get this rally, and then the dollar is going to go down to the mid 90s. Well, I think we're just going to get there sooner.
Okay, you were going to get to the mid 90s sooner. Wow. Okay.
Yeah, yeah. I mean, late this year, early next year, that would be my guess.
All right. Well,
Again,
that means
I
that
think as
gold's
the
got to.
economy, yeah, gold is, I mean, look at this. I mean, how, if we look at it, it's not made a whole lot of upside progress given that degree of weakness in the dollar index. If somebody had told me the dollar was going to do what it has done, where do you think gold is? I would have said over 2,600 easy, So I still think there's one more pop coming in gold above that 25, 29. But from the low last year, this is, I think, wave 5 and positioning. There's a lot of longs in the gold market in terms of large speculators. Sentiment has been, ramping up pretty heavily in terms of people being really bullish.
Sure.
Well, to me, this pop is a pop to sell into because I think it's going to be followed by a pullback back down towards the 2,300 to 2,350. But I still think as long as it holds above that 2,470, and I mentioned that last week, the low in the last 5 days was 2,474. So, that's the line in the sand. If it gets below that, I think we're not going to get the pop. But main point is if the pop shows up, don't do any buying, and in fact, do a little selling.
All right. Well, let's see if that is truly the case. Jim, the next chart you brought up is the Treasuries, and was today an important low for yields?
Possibly. Again, I put these charts together an hour ago, and of course that was before Waller's comments. The 10-year or the 30-year took out that low that I have there. I think it got to 395 something. But my point is, if you look at the 10-year, it has gotten below its low yield from last December. The 30-year hasn't. And sometimes at important turning points, that you get this, what's called an inter-market divergence. And what that means, we're talking about the Treasury market, but now we're talking about pieces within a market, and in this case, the 10 and 30-year. So what I've seen that happens is like a tell, where one of the yields will make a higher high and the other doesn't, or a lower low and the other doesn't. In this case so far, the 10-year has taken out the December low in yield. The 30-year is getting closer, hasn't done it. In the meantime, momentum is still positive, constructive. So if yields tick back up and the 30-year got above that downward blue line, so back in the channel, again, that's a risk. So the RSI is diverging, in the sense that we're making lower lows on the 30-year, but the RSI is hitting a higher high, or pardon me, a higher low. So my recommendation in macro tides, on average, TLT was bought at 91.13, and what I suggested is if it gets above 99.93, sell 1/3. So basically, that's what's happened today, because TLT did in fact get above 99.93 and did in fact get above the high from last December, I think was 100.57. So for me, given all this stuff, that it's like, okay, time maybe to, again, do some selling into strength here. If I'm right though, it'll be just like, okay, any pullback, we're going to look to be a buyer. Because if the economy slows meaningful, goes into a recession as we get into next year, I still think TLT is going to 105, 109 with an outside chance of 119.
I was going to say it's still very supportive of the bond market overall.
Yeah.
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 Okay.
Yeah. Yeah.
All right.
It's just we're a little, we're getting to a point where to me it's like, okay, take something off the table. It's up 10% from, where it was bought 3 months ago. So
So, Jim, the last chart you brought is the S&P, and obviously the S&P is broken lower this week.
Yeah.
It looks like we're making a long-term lower high. Is this shifting your idea that we're going to hit all-time highs?
Uh, a little bit in the sense that, last week we talked about a triangle. Well, the 5561 was the make or break on the triangle pattern, which implied that we're going to get a pop up above 5,700 to finish the rally from last April. This weakness this week increases or decreases the chance of a new high. At the same time, I can point to, okay, nothing completely has erased that potential. This could be wave 4 that sets us up for one more move up to a new high. My point in Monday's weekly technical review was that we get this high. I think a decline back down toward 50, the 5,100, 4,950 is what comes next. So it's kind of like, okay, in the bigger picture here, if we get this high, you definitely want to be a seller because what follows is a decline. Is it
But
possible that that decline has started? Yeah, it is.
okay, I was going to say, what if it doesn't happen? I mean, if it doesn't happen and let's just say, for argument's sake, we just head lower from here, where would
Yeah,
your targets be? I mean, are we
yeah.
targeting, are we talking, are you talking to S&Ps going to 1,000, or are we going to, maybe 4,800 in a more of a straight shot? I'm joking
Yeah,
about that, obviously. So,
yeah. No, I mean, I don't think it's a straight shot, Blake, because again, I don't think the economy's rolling over sharply. Again, gradual slowing. And I think, again, I still think the odds favor one more new high. If that's not the path, it would also seem likely that at a minimum, you'd get a rebound back up to that 55, 55, 61 range where it just broke down from. You broke the support, you kind of go back up near it. And then if it rolls over from that, then declines to the 5,100, 4,950, which was the low in April. Those immediately become the targets. If we go into a recession, now you're talking 4,100. And ultimately, I think next year you're at 3,500. You're going back to the lows of October of 22. But we're just not there yet. I mean, for me, there's just not enough evidence to say, hey, we've begun that decline. We got to take it one step at a time. But,
sure.
in a sense, we're at an inflection point. And what happens with the data at inflection points, like, okay, we've been in, an expansion and things start to slow. Well, you get a data point that shows that everything's okay, and you get a data point that maybe not so much. And it's when you get to that point where consistently the data comes in less than expectations and definitely weaker. I just don't think we're quite there yet.
So Jim, last week, I want to end with this really quick, just a conversation. Last week you said the market was pricing in way too many rate cuts. It looks like they continue to price in way too many rate cuts, and maybe
Yeah.
even a little bit more, like front loading a couple of 50 basis point cuts back to back or something like that. Is the market out of touch here? Or, I mean, are economists out of touch here, or are you starting to lean in that direction again?
Well, again, if we're going to get more cuts, it's not going to be because the Fed feels like doing that. It's going to be because the data, as Waller said, hey, if the data really comes in, I'm paraphrasing, okay, because I haven't read his specific comments. But if the data comes in and surprises us to the downside, well, we're going to respond. Okay, so, Wall Street is expecting 100 basis points in the next 3 meetings, which means the 50 is in there somewhere. They're not going to do it if GDP continues to grow north of 2%. And job growth is okay. I mean, I just again, the composition inside the Fed at those meetings, you have hawks and you have doves. At the July meeting, I think the doves said, you know what? We'll go along with you, hawks, who aren't ready quite yet to cut the funds rate. And in a sense, it was easy because the hawks kind of said, yeah, we think, and I think we talked about this last week and showed a couple of charts. that policy is restrictive. We can debate in terms of the degree of restrictiveness, but it is restrictive. So the hawks are on board with cutting. Now you're going to need real softness and data to get the hawks to say, hey, not only are we cutting 25, we're going to go 50. And so that's why I continue to believe that September is going to be 25. Then people are like, well, then Powell could only do 25, but then telegraph that they're going to be doing more at the next meeting. I just don't think that's where he wants to be. I don't think he wants to. He's been repeatedly saying, every meeting's live. We're taking the data in. And when we get to the time to discuss it, we'll make our decision. I just don't think he's at the point, Blake, where it's going to be, okay, we only did 25, but, in all likelihood, we'll do more next time. I don't see that happening, unless, data comes in much softer than expected. I mean, repeatedly, they've all said we're data dependent for obvious reasons. We're at an inflection point. Everyone's trying to determine, okay, the economy's slowing. Is it going to continue the gradual pace, or are we starting to see signs that the slowing is accelerating? And I think that's coming. I don't know precisely when, but it's coming, and that's what's going to dictate the Fed. The stock market, though, I think if we get decided information that the economy is slowing, I don't think the stock market's going to weight rate cuts more heavily than, gee, the economy really looks like it's slowing. That means earnings aren't going to be so hot. I mean, I just think you get to that point where you tip, where the story has been the economy's fine. We don't have to worry about a recession. Earnings are going up, and the Fed's going to be cutting rates. Well, if the Fed starts cutting because the economy isn't so fine, I'm just not convinced that the market is going to be able to rally in the face of that.
Well, Jim, I want to thank you for guiding us each and every week. And if you all find this these interviews with Jim Welsh from Macro Tides very, very beneficial to you, make sure you give him a thumbs up and subscribe to the channel, and make sure you email Jim to get the most recent technical review that you've written. And Jim, where do people email you?
Jim Welsh Macro at Gmail.
All right, there you go. Well, Jim, thank you so much for spending your time with us every single Friday. I enjoy it, and I hope you do as well. And I hope all of you at home do as well.
Well, let's all have a good weekend as well.
Yeah, have a great weekend. And you too as well, Jim. Thank you very much. We'll see you next week.
All right, you got it. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.